Oh boy, it's finally happening. Figma has filed their S1. This is the document that you need to file if you want to sell your company on the stock market. This means that Figma is about to become a publicly traded company, which means they're a public company, which means we have access to a ton of data that we didn't before, including but not limited to their $300K a day bill for AWS. Yes, $300,000 a day is their expected spend, including how much money their recent acquisitions have cost, including their current revenue, which is a number that is being misreported all over the place, but I dug in to get you the real numbers, and so much more. This is really interesting, especially if you've kept track of the history of Figma, in particular, the Adobe acquisition that was barred a few years ago. This is a wild ride. I am so pumped to break it all down with you guys. But as you know, Figma doesn't pay me anything, so we need to cover the bills quick. Quick word from today's sponsor to do that, and then we'll dive right in. It's never been easier to go from a mock to a working application. All these AI tools have made it hilariously simple to just hand it the screenshot or import from Figma and get moving. What if you don't have that initial spark, that starting point, that inspiration to work from? Then it gets a lot harder, and none of these AI tools for making designs have gotten particularly good, unless you want to just make yet another ShadCN app that looks identical to the documentation. Unless you use today's sponsor, Mobbin. I was curious how useful this would be when I first saw it, and as soon as I tried it, I fell in love, and I use it almost every day now. Let's say you want to add a getting started flow to your mobile app. You can go through all the getting started examples that they have for all these different types of things and get these real screens from real apps to compare against. If you want to switch to web examples, just click the web toggle, and now you have a bunch of examples from real websites on the internet today. If you ever tried Google image searching to find good mocks, you know how annoying it is to get this. Now that it's all just in one place that you can search through, it's so much easier. You can filter for different screen types, you can filter against categories, like let's say you're building a crypto site and you want to make sure you blend in with the other ones. There you go, that easy. Now we have a bunch of mobile crypto apps that we can find, I don't know, let's see how crypto apps handle accordions. Here we go, a whole bunch of examples of how crypto apps do accordion views in their different experiences. Here's the one from crypto.com. Or if we want to hop into less sketchy businesses, switch to AI. And here are some accordions that exist in AI views. Here's the open up and close in Grok. Here's the pop-up breakdown for Arc Search. Here's the one inside of the Particle News app. And God forbid you use Copilot for a reference. It's there if you want to look at it. I'm still blown away with how useful Mobbin's been for me, especially when you consider how hilariously cheap it is. Just $10 a month. That's nuts for the value I'm seeing from it today, and you'll see it too. Check them out today at soydev.link/Mobbin. Let's start with their statement, and then we'll start breaking things down from there. They submitted the confidential draft of their S1, now available to the public. So it was submitted in April, now we all have it. Filed the registration statement on Form S1 with the U.S. Securities and Exchange Committee, the SEC, relating to a proposed initial public offering of its Class A common stock. Figma has applied to list its Class A common stock on the New York Stock Exchange under the symbol FIG. The number of shares to be offered and the price range for those proposed offerings has not yet been determined. The offering is subject to market conditions, and there can be no assurances as to whether or when the offering may be completed, or as to the actual size or terms of the offering. It's a bunch of fine print. Cool. Let's dive into it, shall we? As always, these documents are long. They're full of both like marketing mumbo jumbo and these really fancy looking graphics and things. 821 million of lifetime revenue, 46% year over year growth, 18% operation margin, 91% gross margin, yada yada. 78% of Forbes 2000 companies use Figma, and 76% of customers use 2 or more Figma products. These are really good looking numbers. There are things that aren't great about the numbers, though, and we will look at those in just a bit. 13 million monthly active users, 2/3 of them are not designers. 95% of Fortune 500 companies use Figma. That's crazy. 95% of Fortune 500s using this one product is nuts. So Figma's revenue a year is about 750 mil for 2024. Their gross profit was 660 mil. That's really good. These numbers are a lot better than I expected them to be. The last 3 months of 2025, they did better numbers than the 3 months of 2024. They did 156 mil in last year, and they did 228 mil in this year in that 3-month window. So yeah, that number's not as bad as I expected. What is bad is their AWS bill. They committed to a cloud hosting agreement with a third-party provider that they started in May of this year. They committed to a minimum of $545 million spent on cloud services over the next 5 years. Oh, look at that. there's the details of the Payload acquisition. If you're not familiar, Payload CMS is an awesome CMS. I've done an ad for them before. I'm really close with James, the founder. They acquired them recently. I love Payload. If you're building a CMS or a platform that needs one, the ability to just npm install this into an existing Next.js app and have the entire backend handled, all free and open source, is really cool. You might be wondering how they made money. They had quite a strategy. Their strategy was that they would build really obscure plugins for things that nobody wants to maintain and then sell those to companies instead. So big companies would buy these licenses for weird integrations, and everybody else would just install the package, plug it into a PostgreSDB, and move on with their lives. Really cool product. Figma, as I mentioned in my previous Figma video, is interested in making the WordPress adjacent play, but building all of the pieces you need in order for that to work is not fun. And doing it in a way that developers will actually like is really hard. Payload is one of those companies I've never heard anybody say anything bad about. I know a ton of fanboys of it. They are the perfect solution to integrate into the Figma product and platform if you want the code gen / blog building, commerce building, content platform building solution to be properly unified. It makes so much sense for that. So now we know the number. I didn't actually know the number. I didn't have the balls to ask James. Yeah. 35.5 million was the number. 25.1 million subject to ongoing employee services and will be recognized as post-compensation over the service period of 4 years. Yeah, that's really common. When an acquisition like this happens, a chunk of the stock is cut out as equity that the team gets over time. So when they acquired the company, all of their vesting reset, and they have 4 years of vesting in order to get the equity from that acquisition. So this is just all the things that they have been doing that cost a lot of money. The real funny thing in this piece is the decision to purchase $30 million in Bitcoin. They also purchased a bunch of stablecoin that they plan to put into Bitcoin at a later date as a hedging bet. Fascinating. RSU grants, the board of directors, purchase commitment. This is the part that we're here for. They agreed to spend $545 million on AWS over the next 5 years. They aren't spending that much now, but they plan for it to go up over time. Rohit actually went and did the numbers based on their existing spend. The expectation is if the amount they spend goes up, that they can get to that 545 million number. But right now they're spending 50 million a year, which is around 136K a day. This averages out to them spending 300K a day at that crazy number though. Kind of nuts. These numbers are less bad than I thought they were. We still have a lot to dig into here. So the first big question, so why would a company IPO? The trajectory of a startup is probably worth understanding before we go too much further. The vast majority of companies that eventually go on the market for people to buy stock in are doing that in a similar process. So it starts with some people have an idea. Might be one person, might be a couple, but they sit and they build it. And usually the first thing they build is wrong and they have to change it again. At some point, they quit their jobs if they have them, or they need money for some reason. And if they don't have a way to get customers early to cover those costs, which almost nobody does, they end up raising a bit of money. So they have an idea, they raise some money. This will be either a seed or a pre-seed. I've talked about how seeds and pre-seeds work a bunch. The TLDR is that you are talking to people who have some money around and they're investing anywhere between $5,000 and $1 million into your business really early on what is effectively an IOU. The main method for this is a safe investment. Safe investments are secured against future equity. It's basically an IOU. So if I invest 100K at a 10 mil cap in a safe, what this means is when you do your next round and you're actually creating stock, if you end up being worth 100 mil, I'm converting as though it was 10 mil, which means my 100K becomes 1% of your company. Even if you're worth 100 mil, I still get my 1%. But if you're actually only worth 1 mil in the end, or whenever your next event occurs, then my 100K converts at the 1 mil, so I get 10% instead. There's a really nice way of investing because it protects both the business and the investor. It lets the business raise money and not have to assign equity and deal with all the consequences there. And if they end up being worth more money, you still get the percentage that you paid for. It makes everything easier for everybody involved. It protects the investor. It makes life easier for the business. It's a really good way to do investment. And I'm very thankful that YC invented it and open sourced it so everybody can use it. I could rant about this forever. You get the idea though. You raise some money at a pre-seed or a seed stage through safes, then get some customers. And once you prove that you are onto something, once you've established this is the right product or the right direction, here's our growth, here's our customers, we want to go harder, we want to go further, but we need more money. Because if you go from making zero to suddenly making, I don't know, 500K a year, you still have a bunch of people you need to pay. Maybe you want to ramp up sales. Maybe you want to hire more engineers to build something for a different platform. Maybe you need more money to do more things and get where you're going faster. Maybe you just need it so that you can match the features of bigger companies that are competing with you. Do you know how tempting it is for us to hire an iOS expert to build the mobile app for T3 Chat right now? There's a reason for that. It's because the competition has a bunch of them. I don't even want to think about how many iOS engineers work at OpenAI right now. If we raised more money, we could justify doing that, even if we then were spending more than we make. Most businesses choose to spend more than they make for an amount of time in order to make the business more likely to succeed and be in a better position to beat out the competition. So after you get some customers, you raise more money. This time you're raising a Series A. And the Series A usually is people buying actual equity now. It's no longer IOUs. It's much more formal. You get a little stock certificate telling you how much you own, all the bullshit there. You usually also end up having to give up a board seat. Somebody else is now investing a lot of money, a firm, a lead, somebody else. And they say, okay, we'll give you $5 million, but we want a seat on the board because we want to help steer and make sure the company goes in the right direction. So this point is where you start giving up some control of your company in order to have the things you need in order to raise the likelihood of success. And then you end up in the loop. Then get more customers. Then you raise more money because you have more revenue. That'll be a Series B. And each time you do this, the valuation you're raising against goes up. So you can start at 10 mil, maybe the Series A is at 100 mil, maybe the Series B is at 500 mil. You keep raising the amount that the value is for the business and raising more money as a result, because your goal is always get as much money for as little percentage as possible. So how can you get more money in your company's bank account so you can spend it, giving up as small a percentage as possible? So you want to inflate the investment valuation so that your company is giving up less a percentage. Because if you're trying to raise $10 million, you could raise that at 100 mil val and give up 10%, or you could raise it at 200 mil val and give up 5%. So you go through all of these over and over again, and then an exit happens. There's a couple ways the exit can happen. The company can run out of money and go bankrupt and shut down. Ideally, this far in, that doesn't happen. Usually, if it's going to go that badly, it happens much earlier, but sometimes it does happen later on. Bankruptcy occurs in these businesses. In the early stage ones, like the further you go down this line, the more likely the company is to succeed. On average, 1% or less of companies make it out of seed stage without failing, bankrupting, or selling at a lower val. 1% go through at best. Once you get through Series A, it's probably a lot higher. I don't have hard numbers, but I'd be surprised if it's less than 10% have a decent exit at that point. Series B probably goes up again, 20%. Every time you survive one of these stages, your likelihood of not failing goes up. And eventually, an exit happens. It could be the fail case, but it could also be a better case. The two that usually happen are acquisition and IPO. These are the two ways your business can exit. That means that all this equity that these people have, which, by the way, during all of this, you can't sell the equity. When I invest in a company with a safe, it's an IOU. I can't use that IOU for anything. It's just an IOU. I don't own any equity in the almost 100 startups that I've invested in because most of them haven't converted to real equity yet. But that also means I can't sell it. I can't access this money. That's why accredited investing is such an important thing, because if you don't have enough money to justify that, and then you run out of money, you can't go and get it from those companies. So now, in this stage, either acquisition or IPO, this is where you get some money. When Cursor acquired Supermaven, they bought the company out. They gave some cash, but they also gave some equity. I had an IOU, I had one of those safes in Supermaven, and I had the option when Cursor bought them, do I want just cash back, or do I want some cash and some equity in Cursor? And obviously I picked the option where I get more equity in Cursor because I knew where that was going. It's been very well for me. That was an acquisition exit. That also means I still have this stock I can't do anything with. I'm just sitting on this stock with Cursor, but eventually, I think at least, it'll be worth a lot of money. Eventually, Cursor will get acquired themselves, and I'll trade again that way, or an IPO will happen. An IPO is when it goes to market and anyone can buy and sell the stock. I would be sitting on a ton of stock for these companies once they IPO, and then I can go sell it on the stock market the way anyone else does. And often with acquisitions, it's a bigger company that's already IPO'd doing the acquisition. If T3 Chat was to be bought by Raytheon, for example, all of the stock for our business would now be part of Raytheon. And some amount of that would be a trade where they're giving us stock for the value and they're giving our investors stock for the value. Some amount would be cash. But now everybody who had stock in my company, T3 Chat, now has stock in Raytheon that they can do what they want with. You get the idea. These are the two ways that stock becomes something. And every business aspires to go down one or either of these paths. Everybody's dream when they run a company is to IPO or get a good enough exit via acquisition. So what's going on with Figma? How did they come in here? How did they make their decision between these? Figma's in a really interesting place, and this is where my controversial takes come in. Figma got kind of screwed. Figma was going to be acquired. You guys might remember this. Adobe was going to acquire Figma for $20 billion. The deal had to get terminated because of regulators having fears about competition and monopolistic practices. And believe me, I hate Adobe. I am one of Adobe's top tier haters. I love crapping on them. It's my favorite thing to do. We are pretty much, we're entirely Adobe free at Ping in T3 chat and for my YouTube channel as well, except for Frame.io. I do love Frame. They were acquired by Adobe. It's a good platform for doing video reviews as part of how we manage our sponsor pipeline and stuff. It's a good enough product. Believe me, I have my problems with Frame. But other than that, we don't use any Adobe software for any of our stuff for any of my businesses. I do not like Adobe. All my thumbnails are done in Affinity Photo. All our videos are edited in Final Cut. All our graphics is done in other Affinity software or even in Figma. We avoid Adobe to the best of our ability because I do not like them. Know that as I say, this sucks. The fact that Figma couldn't exit that way is not good. It is unfortunate that Figma did everything right, built a business that was really successful, and they had a happy path to not having to worry about profitability and making every number perfect in order to do the utter fucking chaos bullshit that is filing an S1 and going through all of this crap, these hundreds of pages and years of work in order to make your company publicly traded. This shit sucks genuinely to do. And most founders don't want to have to go through all that, especially if they have a happy path where an aligned brand will let them do things that will make good product. I honestly saw a future where Dylan, the CEO of Figma, would become the CEO of Adobe, which would have been really good for everyone. The problem is that Adobe was not allowed to buy Figma because of the concerns about regulation and market manipulation and Adobe just buying the winner when they lose. And I understand the concern. Having a proper, free, fair market is important. At the same time, the people who built Figma deserve the ability to find success for the thing they did. And while on one hand, this is bad for Adobe, Adobe doesn't have this big company that is making their lives harder. On the other hand, this makes life much harder for Figma. They had planned around this acquisition. They had a really happy path. The founders were content. Everything made sense for them. They saw a future where they could build Figma the way they wanted at a company that would pay them what they deserve, and they weren't allowed to do that. And as much as I absolutely hate Adobe and it would have been scared of them running Figma into the ground, knowing that a hardworking team is not getting the payout that they worked hard for, that sucks. That sucks really hard. There are probably people who work at Figma that went and bought a house because they thought that their equity would convert into Adobe stock that they could sell to pay for the house, and then that was lost. There were probably people that were really excited to retire and take the money that they had made or the stock that they had working at Figma for 8 to 10 years that couldn't because this got blocked. There were a lot of individuals that worked really hard that didn't get something that they, in my opinion, deserved and were entitled to, that they had done the work for, because of fear of Adobe getting too much power as a result. While I both understand and want everything possible to make a more free market, what this did for me was really scary. This meant to me, no design tool can exit via acquisition if it is too successful. The fact that Figma wasn't allowed to sell to Adobe effectively means there is no world in which a company as successful as Figma can sell, because there is no other company that would be interested in buying them that can afford that price that wouldn't be seen as anti-competitive. So Figma almost destroyed themselves by being too successful. And if they weren't able to find a way to be profitable at that point, they would be screwed. If their value was 20 billion, that's what they had agreed upon, and then that couldn't happen, that kind of screws them because now they have to IPO. The reason that they IPO'd is because it is the only option that they have now in order for people who own stock in Figma to make money. So what did they do? I actually don't know if Figma was profitable at the time of the Adobe acquisition discussion. What I do know is that as part of this agreement, since Adobe had to back out of the acquisition, there was a clause in the agreement they made, which was a termination fee of $1 billion. That $1 billion gives Figma enough time to unfuck their business and make it profitable and make it as successful on the books as possible so they can then have success with the IPO. So basically, Figma went from having a happy exit, everybody makes their money, everything's good, company can keep iterating as normal, to you have $1 billion in 2 years, good luck or you're getting fucked. And you know what? They did it. They pulled it off. Their revenue for 2024 was $750 million, 48% higher than the previous year. The first 3 months of 2025 were $228 million, which is 46% higher than the 3 months in March. Their revenue is consistent year over year. It's been 53% year over year for 4 years averaged out, which is nuts. Their growth is really, really good. And that 4-year number is picked both because it shows long-term growth, but also because it shows how hard they worked over the last few years to be in as good of a position as they are right now. I'm finding so much interesting stuff as I read through this. These charts are particularly fun. These are the revenue based on the cohort. So this is how much money they're making based on when the customer signed up. So 2024 customers make them a lot of money. 2021 customers started increasing their spend over time, but are close to 2024 customers. It's very interesting to see your growth in this method of when did they come in and how much of your revenue is coming from them. The more interesting charts are how much of their revenue is coming from customers that pay more than $10,000 a year. So they have 11,000 companies that spend over $10K a year on Figma, and they have over 1,000 customers spending $100K a year on Figma. That's kind of crazy. This is $100 million by itself, just from customers, just from these 1,000 people. They're doing $100 million a year. And obviously a huge part of their goal is to make it so more and more companies are paying them a full-time engineer's salary a year. That's 1,000 employees worth of compensation, basically, just from these 1,000 companies. It's nuts. So that is a big part of what's driving the way they're thinking. But this also says that the smaller companies and the smaller teams that are spending less aren't as much their focus and aren't necessarily as much the thing that they're converting the best right now. But a $100,000 Figma bill is still just something that's terrifying to me. The opportunity ahead. The 13 years since Figma was founded, the amount of software in the world has exploded. According to a Gartner forecast, worldwide software spend is expected to exceed $1.2 trillion in 2025. Meanwhile, generative AI has made digital products more ubiquitous and much easier to build, with the IDC estimating there will be more than 1 billion new apps in the world by 2028. And here is where we get into the last reason that they are IPOing now. We have established why they have to IPO as their exit and they can't do the acquisition anymore. They are worth too much money. This is also scary because a new competitor to Figma has to choose at a certain point. If they're worth $1 billion, they probably need to exit then, because if they get too high and get too popular, they can't do the acquisition path. They have to IPO. So we know that they have to. Why now? Here is another one of my bold, big takes. Figma is in danger. I talked about this in my previous Figma video. But I previously kind of needed a Figma subscription. Not me specifically, but when I had designers, which I needed to make products that looked good, I would have to pay a designer to use Figma to make designs to send to us to then go build into our product. We don't need that anymore. It benefits. I'm not saying designers aren't deserving of money and don't have jobs right now and aren't super valuable. I'm not even saying we don't need a designer. We do. You've seen how good T3 Chat looks. You saw how bad it looked before we had 2 designers come in and help us overhaul it. Designers are great, but those designers didn't really do much in Figma. They just kind of vibe coded it out in Cursor. And now that we have tools like V0, Bolt, and Lovable, now that we have awesome platforms to do generative UI stuff, now that we have awesome references like Mobbin, who almost certainly sponsored this video if you haven't checked them out. Mobbin has references to tons of different designs from lots of real apps that you can use as reference. Will you make something groundbreaking that's better than all of the competition by using Mobbin for reference? No, but you'll make something that's more than good enough for most cases, most of the time. I actually really like Mobbin. I've been using it a ton more than I expected. Yeah, the point being, the need for Figma at these companies is going down. My bet, the thing that I am largely betting my investment portfolio on and the future that I see, is a future where there are less $100 billion companies and there are way more $100 million companies. With all the fancy AI stuff, all the new infrastructure services, everything from Convex to V0 to Cursor, suddenly smaller teams can do much more. And the idea of making a version of a product that serves 10% of the existing market way better makes way more sense now. The same way Vercel is only useful to 10% of AWS's customers, but they can charge them more for a product that's way better for them. I think we're going to see that type of segmentation all over the market. And we're going to see a lot of these companies with a very small team, like we're talking less than 100 people, greater than 40 mil a year. This is a pattern I expect to see more and more of. I'm assuming Figma sees the possibility of this as well. Now there's a question. If this does happen, will they use Figma? Will this new surge of these smaller companies be Figma users? Or are they going to use all these new tools and solutions? Are they just going to AI generate the design and not even bother opening Figma? Are we going to end up with the what's a computer moment? Are we going to have this generational shift where something as familiar as Figma is to us just isn't for the next generation of founders, of engineers, of designers, of companies? It's a real possibility. And they need to work hard as hell to make sure new designers and old designers, new engineers and old engineers, new companies and old companies, all alike, pick Figma. They have 95% of Fortune 500 companies. Can they get 95% of new ones? Not Fortune 500 companies that are new, companies that are new in general. This is why they're IPOing. It might fail. On one hand, they're making all the bets they can to prevent themselves from failing here. They are spending money in the right places. Like the payload acquisition makes a ton of sense. These are all bet hedges that the company is doing to maximize the likelihood that if this next generation of companies, this next generation of ways of building takes over, that they are positioned well enough to score a large portion of these new customers. But right now they won. There is no question about the current market. Figma won the current market. They have 95% of the highest paying customers. That means they are very attractive as a purchase. This is a stock that I'll probably buy a bunch of when they IPO, because right now they are printing. Their revenue is crazy. Even if they're going to spend hundreds of millions a year on AWS, they're making almost $1 billion a year already. They will almost certainly clear $1 billion of revenue this year, which is an insane number. But will that number keep growing at the same rate? It requires that if the market shifts, they win this new market too. And I'll tell you, when I talk to YC companies, most of them aren't using Figma. I'm thinking through, I don't know of any of the YC companies that I talk to regularly that are using Figma. So I'm not as sure about that. Meanwhile, over 90% of YC companies are using Cursor. It's kind of nuts. There's a huge shift there. I should specify most new YC companies. When I say YC companies, I'm talking about like recent batches, because YC has a bunch of new startups that come through every 3 months now. Do they have designers yet? No. But according to Figma, only a third of their customers are designers. Only a third of the users of Figma are designers. So I don't know if that's a necessary thing. I also don't know at what stage these companies will hire designers at. The value of Figma to these companies just isn't there right now. And if these companies keep succeeding and get to a certain point, they will affect the value of the Fortune 500. These top 500 companies will be worth less if there are thousands of these other companies that are worth more. That's why Figma has to IPO now. There are different trajectories that they can go on. If this is like the chart of Figma's revenue over time, it's been a pretty wild ride for them. They have a really good curve. Their revenue has that wonderful hockey stick curve, the up and to the right, the thing everyone wants. But we don't know what's next. If this is 2025, there's a lot of different places it can go from here. It could keep going up the same way, or it can start to shift slightly. It could go like this, it could go like this, it could go like this, it could go like that. It can't go that way, but you get the idea. Revenue for companies like this looks really good depending on where you cut it. And they know everything to the left of this line right now. Everything to the left of where they are now looks really, really good. And everything to the right might end up being good, but it also might not. From there, as I said, it could keep going. Obviously, that's what people want. It could go up a little and then plummet. Obviously, people don't want that. It could steady out and like grow more linearly over time. There's a lot of different places that their revenue can go. I would say right now is one of the most uncertain times for Figma. We don't know what the future looks like right now. We don't know how good these AI tools are going to get. We don't know if somebody's going to whip together an AI version of Figma that's way better for most of these new companies and slowly crash them from the sides. There's a lot of different directions this could go in, and they know that. The amount of money they make has gone up year over year, but the amount of uncertainty has too. I would argue that if we were to chart, instead of charting revenue over time, we were to chart uncertainty over time, like the likelihood that they will succeed. I would argue that it started really rough, slowly started to do better, and especially around the Adobe acquisition time, it seemed like there was no world in which Figma wouldn't succeed. But with all the Gen AI stuff and all the changes in the market, it feels like the risk profile of the business has gone up a bit. Where previously, even for like a bit, I would argue, starting in like even 2021, the risk that Figma had as a business had gone down so much that it basically seemed like if I could have invested in Figma in 2020, I would have, because there was, at that time, it felt like there was no world that they wouldn't be really successful. But that's changed. All this AI stuff has fundamentally shifted the risk profile of the business. So if you look at these two charts together, if you look at where revenue curve is, and you look at where uncertainty curve is, right now makes a lot of sense to do this. I'm not saying Figma's doomed at all. I want to be very clear about that. What I'm saying is, literally 3 years ago, it seemed like Figma would someday be bigger than Adobe. And right now, we don't know. That is a real shift. That is a real concern that Figma has. That's an existential dread that I'm sure keeps Dylan up at night right now. That's why they're betting on AI the ways they are. That's why they're acquiring companies like Payload. They want to reduce risk. They want to reduce the uncertainty of the business while continuing to grow revenue. But if they IPO right now, suddenly the founders have cash. Suddenly the early employees have cash. Suddenly the investors have cash. Well, they don't have cash. They have equity that they can then slowly sell off and make some money. Because if it does turn out the business goes that way, then it ends up worth nothing. If they were to move the IPO to here after the revenue dropped, the company's worth a lot less money, because investors are largely investing on growth and trajectory. They aren't investing on the depth of uncertainty that they don't understand. Most investors that will be investing in Figma when they IPO don't know anything about design or software development or any of this stuff. They certainly don't understand AI and the risk that it has for the business. But Figma does. They know this. I am certain that if Dylan was to see this chart, he would say, I don't necessarily agree, but internally is feeling this. That is why Figma is IPOing now. I think that's all I have to say about this one. I'm curious how y'all feel. Is this type of breakdown of how the stock market and these companies thinking work valuable to you guys? I know you're here for dev stuff, but I think this stuff's interesting too. Curious what y'all think. And until next time, peace, nerds.